To just talk quickly about some of the key changes. And again, this standard does apply to all industries. So this is one standard for all industries. And so we'll just talk briefly kind of about the major changes here. Again, we spoke earlier about the model in terms of transferring control. The collectability assessment, I think, is much more complex. When collectability is not probable, it could result in delayed recognition, and under this standard, unlike today's standards, you cannot just default to cash being received in order to cure that kind of collectability assessment there. So that is a key change here in the standard. In terms of multiple element arrangements, there is additional criteria that we talked about before in terms of whether or not performance obligations are distinct. And they do have to be distinct both from the customer's perspective of receiving value and then distinct within the context of the contract as well. And again, for allocation purposes, discounts, and if there is variable consideration, those are allocated really among all the performance obligations, but in some cases, you may allocate them to only one or several performance obligations depending on the facts and circumstances. So that assessment in terms of multiple element arrangements is a little more complex than it is under current GAAP. With respect to warranties, warranties are evaluated in this standard as to whether they are assurance type warranties, kind of the basic, it complies with specifications, versus a service type warranty that goes beyond that. And so those service type warranties can be additional performance obligations to which you may have to allocate a portion of the revenue to that performance obligation under this standard. Variable consideration, I think a lot of times under current GAAP here, we defer revenue to the extent we have variable consideration. Under this standard, you do have to estimate variable consideration, so revenue recognition can happen earlier under this standard than it does under current GAAP. One of the big changes for a lot of companies that either receive payments in advance, and when we say in advance, meaning 1 year before goods or services are transferred, or extended payment terms 1 year or more after, there is guidance under this standard that calls for a significant financing component, which means that it could result in the recognition of interest income to the extent you have extended payments, or interest expense to the extent you have an advance payment, which is a change from current GAAP. Again, I think we touched upon this earlier, recognition over time or at a point in time really talks about there are 3 specific criteria for recognizing revenue over time, and those have to be evaluated. That assessment can change from the way companies are currently recognizing revenue today for certain performance obligations. Licenses, again, are evaluated to determine whether they include a right to use the license. So when we talk about the right to use a license, we're typically talking about an on-premise license, either a perpetual license or a term license, as opposed to the right to access. And typically, I think the way that we would think of that is a SaaS type offering where companies are not allowed to take the software on-premise. So those are evaluated differently under this standard. No longer are companies that sell term licenses that are on-premise able to recognize that revenue over time. It's really at a point in time in most situations. Bill and hold transaction criteria are much less onerous under this standard. So if company have that may be a positive there. In terms of uninstalled materials, that guidance changes in certain circumstances. It could result in recognizing revenue to the extent of the cost upon that transfer of control. So that is a change as well. Contract modifications, there's very specific guidance under this standard for contract modifications, which is not present under current GAAP. So there's a fairly comprehensive model for contract modifications or amendments that must be followed when that happens. And it does change the circumstances as you go through that model. It does change the revenue recognition. The balance sheet presentation changes quite a bit in terms of recognizing different contract assets and liabilities, so forth, and receivables. The disclosure requirements, I can tell you that this is one of the major changes. They are very extensive and require much more granular kind of information in terms of revenue disclosures and cost disclosures. This standard does affect costs. I think one of the biggest changes here is that cost to obtain a contract, generally thought about as commissions, must be capitalized in certain circumstances, and fulfillment costs, if you think of direct costs, like in professional services, for example, the cost of fulfilling those contracts. Also, there's a requirement there to kind of match that with the revenue. There are some practical expedients out there for commission costs, but in general, there are new kind of standards with respect to costs that require capitalization and more akin to kind of the matching principle under this standard than under current GAAP. And then the last one is really just gains and losses from the derecognition of non-financial assets, which only affects, certain companies and not everyone there, but, that is a change from current practice as well.